Well, as 2019 comes to a close, some farmers may be required to roll existing unpaid lines of credit on into 2020. But producers should review tax consequences that could arise when determining what to do with existing loans. Roger McGowan with the Washburn University School of Law now joins us today for the Rural Money segment. And Roger, as always, thanks for taking the time to chat with us. So can a borrower deduct interest if funds are borrowed from the same lender that provided the original loan?
Well, that's a great question, Janet, and it is something that needs to be considered as we come down to the end of the year. But basically, the rules are that if you have a loan that has fixed interest that's payable in 1 year or less, then you cannot deduct the interest when you roll over that remaining line of credit at the year end into the next year. And that result is the same if you borrow funds from the same lender that made the original loan, if you're borrowing that money for the purpose of satisfying the interest obligation to the lender. So the bottom line is no, you can't deduct the interest if the funds are borrowed from the same lender that provided the original loan. And that's true even if you have unrestricted control over the loan proceeds. But you should be able to get a deduction if you can show that the newly borrowed funds weren't basically the same funds you used to pay the loan. But the problem that farmers and ranchers may have is that to do that, you're going to have to establish that you have sufficient other funds to pay the interest. So that's a big point to keep in mind as we come down to the end of the year here. And
what are the original issue discount rules?
Yeah, that's something that very few, if any, farmers or ranchers ever take into consideration, and it is a special rule that's out there. OID is a form of interest, and we usually think of that in terms of financial markets, but it can come into play here when you're dealing with a year-end rollover of a loan into the next year. It's the difference between the stated redemption price at maturity and the issue price of that financial instrument. So all debt instruments that pay no interest before maturity are presumed to be issued at a discount. Well, the rule is that OID is taxed as ordinary income. The problem is, or what farmers need to be aware of, is if you roll over a 2019 loan into your line of credit into 2020, then the OID rules may be triggered if that old loan doesn't become payable until more than a year after the original loan was taken out. So if that happens, the interest amount gets spread over the loan's term, resulting in a portion of the interest being deducted in the year the loan is rolled over. And that may be good, it may not be good. It just means they have to be aware of it.
So, Roger, what is the take-home for producers as we head into the new calendar year?
Well, I think the take-home is don't borrow money from the same lender to pay interest on an existing loan from that lender, and take into consideration the OID rules on a rollover. Always talk with your tax practitioner about how you're going to maximize the tax benefit of restructuring loans and deducting interest. It's something that's often overlooked, but it needs to be considered.
All right, Roger, as always, thank you very much for the insight. Roger McGowan, he's with the Washburn University School of Law, joining us on the phone today from Topeka, Kansas.